Hello trader, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the MACD breakout strategy, a powerful technique that can significantly enhance your trading performance. Whether you're a seasoned trader or just getting started, understand how to leverage the MACD for identifying breakouts can be a game changer for you. Stick around as we explore how this strategy works, how you can implement it to your trading routine, and some real world examples that illustrate its effectiveness. You won't want to miss out this opportunity to elevate your trading skills. Now let's look at the MACD overview. The MACD, or moving average convergence divergence, is a versatile indicator used to gauge momentum and trend strength in the forex market. It consists of three main components: the MACD line, the signal line, and the histogram. I repeat it: the MACD line, the signal line, and the histogram. So this is the MACD indicator. The MACD line is derived from the difference between the two exponential moving average of I take that again. The MACD line is derived from the difference between the two exponential moving average, while the signal line is the moving average of the MACD line itself. The histogram represents the distance between the MACD line and the signal line, providing a visual representation of the momentum changes. Understand that this component is crucial for identifying breakouts. A breakout occur when the price moves beyond its defined support or resistance level, often signaling a new trend. The MACD helps confirm this breakout by identifying shifts in momentum before they become apparent in price action. Now let's look at an example. Look at it. You can see the price was consolidating in this area, before we saw a breakout. The MACD has already given us a signal where it crossed each other before it broke out. In this strategy, traders look for specific signals that suggest a potential breakout. One common approach is to watch for the MACD line to cross over or below the signal line. Let us not forget that one of the common understanding that we can get from this strategy is, for us to predict that price wants to reverse, we have to see the MACD line crossing above or below the signal line. This crossover can indicate a change in momentum that may precede a breakout. Additionally, zero line crosses, where the MACD line moves above or below zero, can serve as a continuation of a trend direction. When it moves across zero, zero is this line here, this centralized line. Once it moves above it, it signals a continuation. Now, how do we trade with the MACD breakout strategy? There are step-by-step guides on how to effectively use this strategy. The first step is by confirming your entries. Your entry strategy by confirming breakout. Enter a trade when the price breaks above the resistance or the support confirmed by the MACD signal. This ensures that the breakout is accompanied by an increase in volume for additional confirmation. Let's look at an example. Let me put my volume indicator. As we can see, this is a range, this is particularly a range, and we expect that price, we did not know that price was about breaking out from here. But when we look at this area, we saw that the MACD line crosses below the signal line. This is a sign that we are expecting lower prices. We can take our trade at this area. We can also use the zero line cross. Use zero line crosses as an additional confirmation when the MACD line crosses below or above. In case of above, it supports a bullish trend. In case of below, it supports a bearish trend. Now, how do we exit our trades, or how do we exit this strategy? The MACD histogram refers, it is through the MACD histogram reversals. Monitoring the MACD histogram. The MACD histogram are all these the bar chart you can see around this zero line. These are the histograms. Now, the MACD histogram is for the signal of momentum reversal. If the histogram starts shrinking after expanding, it may indicate weak momentum. At this area, it was giving us a weak momentum before eventually price started coming down and the momentum increased. That's what it means. Now, how do we safeguard our how do we enter this trade and safeguard ourselves from any stop loss, because we must surely manage our risks while trading? We can use a trailing stop loss. In order to implement the trailing stop loss, you have to know how to enter the trade in a position where you give yourself enough room in case price wants to reverse in your area. So it means you have to put your stop orders below or above a recent low or a recent high. In case of a selling opportunity, you put it above the recent high. In case of a buying opportunity, you put it below the recent low. You have to adjust your levels as the new high are formed. That's if you are trying to trail your stop loss. If a new high is formed, you can just put your stop loss above that area. This is how to manage the trade. Let's look for a bullish example. Let's look for a bullish example. At this area of the market, we can notice that price is moving sideways. When price is moving sideways, we need a signal to buy. And at this point, when price was still moving sideways, price crossed using the MACD line. It crossed above the signal line, signaling price has started going into the overbought zone and price wants to go to the upside. When we notice price wants to go to the upside, we check our histogram, our MACD histogram, and we can see that yes, the momentum actually supports this fact, and we can see that price is trading above the zero line, signaling time for buying opportunities. So we can actually buy at this area, then we put our stop loss below the recent low. Then our take profit, you can always go for 1:1, 1:2, or you can actually trail your stop loss. Trailing your stop loss, like I explained earlier, after a new high or after a new high is formed, when you notice price has come to retest and it has broken this high, price has formed a new high, you can put your stop loss at this area while trailing it, just to maximize your profit taking of this particular trade. Please do not try this if you are not experienced enough in trailing your stop loss. Let's not forget that position sizing matters a lot. Always determine your position size based on the risk tolerance and ensure that no single trade risks more than a small percent of your capital. Ideally, you are meant to risk at least 1:2 or 1% of your account. I personally risk 1% of my account, but I would advise that you risk 1 or 2% of your account at maximum. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, don't forget to like, subscribe and share this video. Turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.